สวัสดีทุกท่านนะคะทั้งที่อยู่ที่นี่แล้วก็ที่ทำผ่านเว็บก็ได้เวลาของการนำเสนอข้อมูลของบริษัทพีเชียชิปปิ้งณสถานที่แห่งใหม่วันนี้ณบ้านใหม่ของตลาดหลักทรัพย์นะคะค่ะการนำเสนอข้อมูลก็จะเริ่มด้วยของในเรื่องของอุตสาหกรรมโดยกรรมการผู้จัดการของเราคือคุณคาริดฮาชิมแล้วก็จะต่อด้วยในเรื่องของตัวเลขทางการเงินผลประกอบการโดยกรรมการทางด้านการเงินคุณกุชูวาเดียและช่วงสุดท้ายก็จะเป็นการคำถามคำตอบนะคะเชิญคุณคาริดค่ะ
Good morning, everybody. We will take this presentation in two halves. In the first part, we will talk about the industry structure, and in the second part, we will discuss the finances of the company. Okay, so if you look at this slide, it shows you how the commercial markets for shipping are broken up. And if you look at the dry trades and look at the sectors that we've highlighted for you, you can see clearly that pressure shipping is now involved in the small handy size all the way up to the Ultramax sector. These are all geared ships. Now, if you look at the next slide, it shows you the Baltic Dry Index, and you can see that it is an extremely volatile index and measures the availability of ships versus availability of cargoes. So if there are more cargoes and less ships, then you have the spike that you saw in 2007 and 8, and the Baltic Dry Index reaching an all-time high of 11,793 points in May of 2008. And then when there are more ships than cargoes, as you have today, you have an all-time low of 290 points, which was there as of the end of last week. Since then, the index has gone up by 5 points. Yesterday it went up by 4 points, and on Friday it went up by 1 point. If you take the next slide, it shows you the averages of the BDI, and you can see from this something of a cyclical pattern. And in this pattern, you can see that the BDI average for last year was the second lowest in history, just 4 points above the lowest level. If you look at the next slide, you will see the seasonality. So this shows you how the index moves with the seasons during the year. The important thing to remember is that in the months of July, August and September, the market is generally at a low point. It's also at a low point during the end of January, early February, when there is Chinese New Year. So these are the two major events which make the markets come down. Chinese New Year is easy to understand. Chinese take a break of almost a month during the New Year period, and all industrial activity in China slows down, and therefore the demand for raw materials comes down. So that's why you have the sharp fall in January, February. The fall in July, August and September is for two reasons. One is that the OECD countries, that is the developed world, they go on holiday during the months of July, August, and therefore industrial production slows down over there. At the same time, there is no grain movement in the world during those months. So these two factors make the months of July, August and September come down. Now, if you look at what happened last year and look at the next slide, you can see that there was no seasonality at all. There was a slight slowing down during Chinese New Year, and instead of going down in the summer months actually the market went up, and we reached a peak point of 1,222 points in the month of August, in the early part of August. And the reason for that is that the markets were so low in the first half of the year that we had a record number of ships being scrapped. That slowed down the supply side, and the market spiked up in August. But minute the market spiked up, scrapping came to a standstill. New supply kept coming into the market, and the market collapsed thereafter. So if you look at the next slide, it gives you the asset values. And from this you can see that 2015 was more or less the low point so far. However, I suspect that 2016 will be the real low point. So we are now reaching what I think is what happened in 1986, 1985, when the markets really came down. If you look at the next slide, it shows you the operating expenses. Here, operating expenses have been rising all the way up to 2013. In 2014, they have slightly slowed down. And the reason for this is that the markets were starting to, the expansion of ships was starting to slow down. And therefore the demand for officers and crew, which is the real reason why the expenses have gone up, started to slow down a little bit. If you look at the next slide and look at the 1-year time charter rates, again, they show you that we have reached a low point in 2015, but my suspicion is that 2016 will be much lower than these numbers. If you look at the next slide, we look at the way the number of ships and deadweight tons has progressed. And if you look at that, you can see in the upper half of the slide that the world fleet of dry bulk ships has now crossed 11,500 in numbers. They're less than 9 years old on an average age, and a total deadweight of 788 million tons. The average size is today a Panamax size of 71,000 tons. If you look at the lower half of the slide, you can see that during 2015, the only sector which had negative growth was the small handy-size sector. All other sectors had positive growth. If you then come to the next slide and look at the new buildings which are still to come in 2016, you can see that roughly 93 million tons of deadweight are scheduled for arrival in 2016. Thereafter it comes down to 25 million tons, then another 8 million tons, and down to 1 million tons in 2019. And what we have done is also we have broken down this for you year-wise and size-wise. So you can see that the largest growth is of course in the Cape-size sector. Then comes the Ultramax, the Panamax, and then the Handymax, then the Supramax, and then finally the small handy size, where there is the least amount of growth. If we then look at the next slide and see how many ships were ordered in each year, you will see that the peak ordering took place in 2007, where approximately 170 million tons of ships were ordered. The next record was in 2008 and 2010, roughly the same at about 105 million tons. And in 2013, and then you come down to the lower levels. And if you see in 2015, a very low level of ordering has taken place. My suspicion is that 2016, you will see even a lower figure than this, because the markets are so poor that owners just cannot order new ships. If you come to the next slide and look at the scrapping, then you will see that in the past, in 1986, when we had a huge amount of scrapping, if you look at the tower block, of course, 1986 looks very small compared to what we've seen in 2012 and what we have seen last year. But if you look at the quality or the age of ships being scrapped, in 1986, the average age was coming close to 15 years. Today, the average age for scrapping is still around 25 years. So there is still scope for more scrapping to take place. And if you look at what's happened in the first month of this year, then 5.3 million tons of ships have been scrapped, which means if that same rate of scrapping continues, then you will have roughly 64 million tons of ships that will be removed from the sector. And if you remember in the previous two slides previously to this, we said that there's 93 million tons of ships that will arrive this year. If you apply the same slippage rate, which was there last year, which is 46.03%, then approximately 51 million tons will arrive. And if 64 million tons leave the sector, then you'll have negative growth of 13 million tons. This will be the first year that I can remember where we will have actual negative growth of supply in ships. So if two things happen. One, that the rate which was achieved on scrapping in January continues through the year, and two, that the slippage rate is the same as last year. Now, I think that the scrapping rate of January will be there, I think, for the first half of the year. Thereafter, I think it will slow down. As far as slippage is concerned, I am almost confident that we will exceed the slippage of last year. So overall, I'm reasonably confident that we'll have negative fleet growth this year for the first time that I can remember. If you look at the next slide, it shows you the slippage. And as I said, for last year, it was running at 46.03%. So what I've done in the next slide is to show you on a very conservative basis what would be fleet growth. And here we've not used the run rate established in January. We've just assumed that it will be slightly stronger than last year, and we've assumed a scrapping of only 36 million tons, which was the largest ever in 2012. We have assumed that number. But it could be as high as 64 million tons if the January rate is repeated right through the year. So if you take 36 million tons for scrapping, and if you take 45% of slippage, then you get a marginally positive growth of 1.92% for this year and 0.12% for next year. So it looks like finally ship owners have understood that oversupplying the market with ships is not a good idea for their business. If you come to the next slide, you will see that another factor affecting us on the supply side is congestion. If you look at it as recently as 2010, it was so much higher than what it is today, which means more ships are available for carriage of cargo, and therefore this is adding to the competition. If you look at the next slide, these are the macro indicators. It looks like America is finally has already raised interest rates, and there is talk of further interest rate raises. People are guessing that there will be maybe between 2 and 4 interest rate increases this year. So it means that if there are 4 increases, that America is really doing very well. If there are 2 increases, it means America is doing well. If the increases are less than that, it means the American government and Federal Reserve are worried about the American economy and they do not want to raise interest rates. So this is a good data point to look at. India is continuing to support the dry bulk market. Of course, India can never match the support that we got from China, and therefore it's quite important for dry bulk that China comes back in a better way than they have done so far. If you look at oil prices, they've come down significantly, and the predictions are that this oil price will remain at a low level at least for this year and next year, and this should help get more money into the hands of the common consumer, and therefore we should see some sort of an economic revival taking place from the grassroots upwards. In terms of the bad news on the macro front, China is slowing down. There's no doubt about that. It's a question of degree. How slow will the slowdown be? In terms of the Eurozone, they are still struggling along. They've still not been able to come out of their economic paralysis. So again, it's a very patchy recovery. Some countries within the Eurozone are doing okay. Other countries are doing very poorly. In terms of Japan, which is the other major dry bulk player, Abenomics has had mixed success. Sometimes they seem to do okay, and at other times the recovery seems to stall. If you come to the next slide and look at the China numbers, you can see that for GDP, 2015 was an average of 6.9%. Iron ore imports actually went up during 2015 compared to 2014. Coal imports were much slower, 30% lower than last year. Steel production was almost the same, just marginally lower, and steel exports went up significantly, almost by 30%. So overall, I would say China for the dry bulk market was reasonably neutral. It was not overly positive, but it was not overly negative. If you look at the next slide, this shows you the proportion of iron ore being exported from Australia, that's the blue line, and the proportion being exported from Brazil, which is the red line. Now, if the red line starts to go up, then you will find a revival in the market coming about very quickly, because Brazil is roughly 3.5 times more ton-mile intensive than Australia. What this simply means is that it takes 3.5 times longer for a ship to deliver the same amount of cargo from Brazil as it would take from Australia. So if there is growth in cargo from Australia, it's good, but not very good news. But if there's growth in cargo from Brazil, then it's very, very good news. If we come to the next slide, these numbers show you on a macro scale that China still has a long way to go to get developed. So for example, if you compare the land mass of China and USA, they're roughly the same. Actually, China is slightly larger. And if you look at the rail lines in America compared to China, then China still has enough capacity to double its rail lines before it reaches the level of rail line networks in America. If you look at India, of course, it's a really poor comparison. India needs to develop and is trying to develop its infrastructure in a larger way under the new government. So we have hope that India will continue to impact the dry bulk markets favorably as long as the Indian government continues on their expansion program for their infrastructure. So coming to the next slide, we can summarize what are the risks that are there for 2016 and what are the upsides. Unfortunately, when we were doing this slide, we didn't change the dates on it, but it's for 16, not for 15. Main risks are geopolitical, China slowing down, the BRIC countries slowing down except for India, the Eurozone slowing down, protectionism increasing. People are starting to put up tariffs, like even India's put up some tariffs against the cheap steel being exported from China. So all these things will act to delay and slow down cargo movement. The surplus supply is not being absorbed fast enough, and excess shipyard capacity continues to produce ships. Similarly, if you look at the upside potential, right now, as I said, very few ships are being ordered, so the forward book is getting weaker. If you look at the slippage rates, as I said, it's already gone up to 46% compared to 35% as an average over the last 5 years before. So it's gone up significantly, and I suspect that in 2016, slippage will be even higher than this 46%. Scrapping rates, as I said, January has been a record. If it continues like that, we will have the highest dry bulk scrapping year ever in history. If you look at China and the nickel ore that they were sourcing from Indonesia and which got banned in January 2014, they are now starting to import that nickel ore from much further places. So therefore the ton-mile impact has been better. The US economy is still continuing to outperform. Low oil prices should lead to world economic growth rates and therefore to shipping requirements. Low oil prices also help to reduce commodity prices, which should also result in more cargoes being moved. A weaker currency in the Eurozone and the Japanese yen should help these two economies to export their way out of trouble. The Chinese government has laid down a $1.1 trillion infrastructure developmental plan. If that plan comes through, that should also help. The Chinese government is also reducing their reserve requirement ratios in their banks. They've also reduced interest rates, and they're trying to put more money into the system. But that has so far not had the desired effect, because the economy is so large now that when you start these reserve requirement ratio reductions and reducing interest rates, it takes time before it can impact the thing. We suspect that these effects will start to come in from the second quarter of this year. The One Belt, One Road, it's a $10 trillion infrastructure development spread over 10 years. If China goes ahead with this program, it will mean lots of good things. It will mean that the steel capacity that is lying idle right now in China, they can use it to produce very cheap steel for this project. Cement capacity which is lying idle can also be utilized for this project. It will increase the employment aspects in China, and therefore the government will feel confident that they can go ahead with their other reforms that they are undertaking. And it will also remove some geopolitical risks which are there along the route of the One Belt, One Road. And of course, there's talk about America trying to revamp their infrastructure development. So if we come to the next slide, our strategy is simple. We need to expand the fleet now. We need to sell the older ships, and we need to fix our younger ships once the market turns into longer term contracts. So now if you look at the next slide and see the breakdown of the 60 to 70,000 ton size range, you can see that if you come down to the lowermost portion of the slide, you can see that in 2016, 22 million tons of ships are there to come. But as I said, slippage should be about 50%, so you'll only get roughly half this number. On order for 2017 is 7.2 million, and in 2018 and 19 there's hardly any orders then. So the total order book is about 30 million tons. Roughly half of that should start to arrive starting from next year. If we look at the next slide, you can see the breakdown of the Ultramax fleet in terms of age profile, and you can see that the majority of the ships are very young because this is a new sector. It has only come into being from late 2012, early 2013. So therefore, it will always have much younger ships than any other sector in the world fleet. But if you look at the older fleet, older age range from the 20-year plus, you can also see that there are about roughly 20% or 18%, which is fairly old and which could be scrapped. In terms of the lower portion of the slide, you can see the major players and their names, which are in the Ultramax sector. So if you come to the next slide, our plans have changed a little bit. We don't have as many new buildings that will come this year and next year. We have just 5 brand new ships that will arrive. Of that, one is a 38,000 tonner, which has already arrived on the 6th of January. And 4 more Ultramaxes will arrive during the rest of this year. And we have about 12 older ships that we will dispose of between this year and next year. Of this 12, we've already disposed of 1 ship so far. So another 11 to go. And we hope that by doing this, we will convert the fleet from what we see as an aged fleet with uneconomical engines to a younger fleet with more economical engines. And if you see the next slide, it sort of gives you a summary of that. It shows you that by the end of 2017, we would have 38 ships in the fleet. The average age would be 7 years, and the average size would be 43,000 tons per ship. So that's what we hope to achieve in the transition. If we come to the next slide, it shows you the same 7 deadly sins of shipping, or the risks and opportunities that are there in this market. In fact, I would say that today, if we could buy ships at the current prices, they should give the company really long-term growth prospects and profitability, because asset prices, as they are today, are about the lowest we have ever seen. So it's an interesting time to be expanding the fleet, and that's what we are trying to also achieve. If you come to the next slide, it shows you how we have expanded the fleet and how we have contracted the fleet, and then again expanded the fleet against the BDI. So when the BDI was high, you can see we reduced the fleet. When the BDI was low, we've expanded the fleet. So this is a contra-cyclical play, and this is the right way about going about this business of ours. If you come to the next slide, you will see the average time charter rate against the BDI. And this again shows you that if you have some long-term contracts with you, you can easily outperform the market, in the sense that if you see the falls in the market and the fall in our time charter rates, they are they're quite divorced from each other. That is, the market has fallen by very sharp amounts, whilst our rates have actually gone up. If you see in 2008, and if you see in 2009, though the markets came down quite sharply, our rates hardly came down. And that is because we had long-term contracts at that time on the fleet. If we come to the next slide, it shows you the position of the long-term fleet, chartered fleet, and you can see that it's roughly averaging this $13,800 right throughout, because there are roughly 7 ships which are out on long-term charters. The rest of the fleet is, of course, on the spot market. If we come to the next slide, you'll come to market segmentation. And here you can see that in Q4, on the handy size index, we outperformed the market by 35%. But keep in mind that this handy size sector is supported by our 4 cement ships, which are out on very long-term contracts at very high prices. So that is what is helping us to outperform the index. On the Supramax sector, we underperformed the index by 16%. If you look at the whole of 2015, we outperformed on the handy size index by 15% and underperformed on the Supramax index by 5.5%. Now, with this, I'll hand over to Kushu, who will take you through the financials of the company.
This slide gives you the new buildings on order, not yet delivered. Number 1, as you can see, has been delivered on 6th January. Thereafter, we have 8 ships on order from Sanfu shipyard. We expect that 4 should be delivered this year, and the other 4 we are in discussions with the yard on some sort of a solution. The next slide has the details of the orders with St. T shipyard. Over here, if you see the remarks, we have 6 hulls which have been cancelled by the company on account of the fact that these ships, 4 of them which were tendered for delivery, were rejected because they were not built in according to the specifications in respect of 2 issues. The other 2, the next 2, were cancelled by the company because they were not delivered in time. There are 3 more which have been cancelled by the shipyard, and then there are 3 more which, again, under discussion, but probably may be cancelled by the company because they may not be delivered. So in short, we do not expect any deliveries from this particular shipyard, and a number of these shipbuilding contracts perhaps would go into litigation, all or most. This is what we have done in the last quarter. Last quarter numbers, just note, they are derived numbers, they are not published. So if I could just focus on the annual figures. Annual, the big number is that we did an impairment review of all our assets, and we found that for the ships which we think will be sold in the immediate 12 months, on those we had to book an impairment loss. The other ships we have not had to book any impairment because we found on a sort of a longer term basis the ships were not impaired. So the ships which are meant to remain in operation in the long term are not impaired, but the ships which will be sold, yes, because of the lower sale values they have been impaired, and therefore an impairment loss has been booked. This is something which, if you see shipping companies' financial statements of the previous year internationally in Thailand, you will find this a lot. So as and when the financials come out of other shipping companies all over the world, you will find much larger impairments taking place. Other than that, of course, if you look at the other sort of extraordinary charge is the loss on sale of the ships. So we had to sell some ships, and which were where there was a loss. And this is the reason that, because the impairment charge has been taken, that as and when the ships are sold this year, we will not have a loss booked, because if booking a loss on sale means the book values are higher than what they should be if they are sold. If they are continued to be operated, as I said, on a longer term basis, there is no impairment charge which had to be booked. However, even if you look at the last quarter, which was the lowest number achieved in our own history also in the recent past, adjusted for the size of the fleet, even at that time, we had a positive EBITDA of about $2 million. This is not very, very high, of course, and a far cry from what it used to be in the heydays. However, once again, if you look at the EBITDA numbers for other shipping companies all over the world, you may find that there is no EBITDA, or there is negative EBITDA, because the time charter rates which you are seeing now are actually less than the cash operating expenses, let alone even without finance cost, even without cash finance expenses. So most companies and most ships are actually losing money for every day which they are operating, because their operating expenses are higher than the daily income which they earn. Our running expenses, or the operating expenses cost, remains in the region of about $4,600, slightly lower than what it was. The lower number is obviously because of the lowering of the average age of our fleet. The older ships have gone out, and we have had younger ships joining the fleet, which meant lower operating expenses. We expect a similar number in the year to come. Other than that, obviously, given the loss and given these numbers, margins are on the net profit margin is of course negative, but we have somewhat a reasonable gross profit margin of about 28. And that is what is the reason for this gross profit margin, is the reason for the positive EBITDA which we have seen. The next slide gives you the financial position, or the balance sheet. This balance sheet, the big numbers, if you can see, is that there is a reduction in the advances paid to Shanghai Guan, China. This is on account of the fact that we have taken delivery of the 3 ships which were there, or 2 ships last year, and then 1 more ship this year. So as far as this particular shipyard is concerned, this is now a closed chapter. Then we of course have advances paid to Senti shipyard. None of the ships have been delivered other than the 2 which were delivered in the year 2014. And as I said, none of the 12 undelivered ships will be delivered this year. And these advances are backed by refund guarantees. So therefore, as and when these shipbuilding contracts are cancelled, we will claim back refunds. And if there is no refund paid by the shipyard, we will have to invoke the bank guarantees. In the meantime, if we go into arbitration, the bank guarantees would become extended until the final adjudication of the arbitration. So this sort of remains as outstanding, but this is fully secured, subject to the arbitrations or the results of the litigation which are ongoing on the 9 out of the 12 ships. Advances to Sanfu shipyard, as I said, out of the 8 undelivered, we expect 4 to be delivered, so therefore these advances will go down or reduce. And if the other 4 are cancelled or rescheduled, then accordingly the advances probably might also reduce further. So we have had, at the end of last year, we have had 45 ships, which worked out to the net value of $700 million, total assets of about $900 million, against which we have liabilities of $443 million, and we have a shareholders' equity of $460 million, approximately $457 million. In spite of the loss which is there in the last year, we have equity position remaining nearly the same as the previous year, obviously because of the fact that we have done an equity raising in the previous year, where we raised about $62 million, $62 million, which has kept the shareholders' equity and thereby the balance sheet pretty strong. And this is something which the lenders today are looking at. They would be looking at, if they have to support shipping companies, lenders would look at the balance sheet, they would look at the cash position, how liquid are the shipping companies, because they are losing cash every day. So they would want to see how liquid are they, have the companies raised cash through non-core asset sales, have they raised cash through equity offerings, have they raised cash through other kind of debt, through capital markets, and depending on the answers to these questions, they would decide to support or not support shipping companies in this particular situation. This is a breakup of the operating expenses. As you can see, the largest component is crewing expenses. If you include manning and victualling expenses, which are also sort of crewing expenses, we're almost at about 59%. So crewing expenses in operating expenses, cash operating expenses, represent about 59% of total operating expenses. Has been increasing. We could have a slight increase this year also on this, but by and large this should have stabilized now that the number of ships which are being delivered in the world are starting to reduce, or the growth is starting to slow down. Other than that, as you can see, some of the expenses have sort of reduced, the big one being the management expenses. This has also gone down. We have had some oils going down as a result of slightly lower oil prices, not substantially so. So we overall have reduced operating expenses, but as I said, we expect this to be in the region of $4,600, which is what the target is for this year. 2016, the target would be $4,600 per day per ship. However, notwithstanding increases over the years, if you compare operating expenses of the company with world rates, with other shipping companies all over the world, based on survey reports which are done by third-party agencies, you will see that the company's operating expenses are anywhere between $1,000 to $1,400 per day per ship, less than the industry or less than other shipping companies in the world. This is the main reason why, as I said, we have something called a positive EBITDA. If the operating expenses were close to or were more than industry levels, we would not be having a positive EBITDA. So if you look at the difference, $1,400 difference between industry and the company, that translates to, for a fleet of 45 vessels, that translates to something around $15 to $20 million. And that is what the EBITDA was. Last year, the EBITDA was about $14 million. So if we did not have this difference or this lower operating expenses compared to the industry, we would have resulted in a zero EBITDA or even a negative EBITDA, as would be the case for most of the shipping companies elsewhere. This is a pictorial depiction of the operating expenses compared to the industry. As I said, all along, compared to the red or the brown block, the blue block is always lower. This is historical time charter rates, historical average age of the fleet, historical average size of the fleet, and historical operating expenses. The red line is the operating expenses. You will see that from 95 being the peak of the previous boom in the shipping industry, we were at the $3,000 level. Then we came down to under $2,600 in the year 2001, or even in 98, 99. Substantially under $2,600 in 98, 99 on account of the Asian crisis. And then thereafter, from 2004 and 5 onwards, our operating expenses started going up. And if you compare those at that period, when the operating expenses were in the region of $4,000 to $5,000 and went up beyond $5,000 in 2009, you will see that the average age of the fleet was also, it's the maximum. So we had ships which were on an average 21 years old, and therefore operating expenses were at their peak of about over $5,000. However, if you look in those same years, the time charter earnings or the earnings of the company on a per ship level, they were also very, very high. So therefore, the higher operating expenses did not hurt at all, because there was this big gap between earnings and expenses. And now, as you can see, as and when the markets are coming down, we have reached a low point in earnings and operating expenses still being stable, still being at a low level. The gap between the two is very, very marginal. However, having said that, there is still a gap which is perhaps not there with other shipping companies. This gives you the debt equity ratios. The debt equity, we had a peak in the year 97, 98 on account of the Asian financial crisis, when our equity levels were low and the debt levels were higher. We had a lot of debt compared to the size of our balance sheet. We now have, in absolute terms, more debt than what we had in 97, 98. But because the balance sheet is good, because we have good equity, the debt to equity ratio is a very, very conservative 0.9, less than 1, which is a very good number, and does indicate that there is room to raise more debt. And if you have heard or if you have seen the latest news in the month of January, given the fact that we had this kind of a debt equity ratio of 0.9, we have been able to raise more debt from the capital markets by issuing debentures of 5 years at a very, very good price. After swapping them into US dollars being the functional currency of the company, the pricing or the interest rate is less than 6%, which is almost half of what the international pricing is for unsecured debt of 5 years. And this is the one reason, that is, by raising liquidity, this is one reason we expect that our banks will continue or should continue to support us in terms of certain covenant waivers which we will need, or in terms of additional financing, if at all we need, if some of the ships are delivered and we need to draw down against the committed lines. Quite obviously, EBITDA coming down, EBITDA to funded debt ratios have gone through the roof. As I said, we are one of the few with positive EBITDA, and therefore we can still calculate this ratio. With most companies, they cannot even calculate this ratio because EBITDA is 0 or negative. This is a covenant with all our with all our lenders. However, all have been waived. Considering the present situation, there is no way there can be compliance with this particular covenant. This is a historical depiction of what our operating profits have been. By and large, as you can see, barring 2 years, in the Asian crisis, we have had positive cash profit and a good cover for interest. This includes, by the way, this is operating profit after interest. So even after interest, in this particular year, we had about -2. But bear in mind, we are at a point where we are the lowest ever in terms of the market situation. Last year was the second lowest average BDI, lower by just 4 points. However, in terms of operating expenses, which have gone up on account of inflation, additional steel prices, etc., operating expenses have gone up substantially more. So while the lowest BDI is just 4 points less, which is 0.3%, less than what it was ever, in terms of an average, the operating expenses are more than 50% higher than what they were in the mid-1980s when the BDI was at its low point. So therefore, given that kind of a situation, after operating expenses and after our finance costs, we have had a slight cash loss in this particular year. If you can include losses on sale of ships, which is not really that much of a cash loss, and other impairment losses, obviously, this year looks the worst, and it is indeed. This particular year has been the worst, as can be seen, as we have said, by the macroeconomic factors, even in the shipping industry, whereby we have reached lowest BDI, almost the highest OPEX, operating expenses levels in history, and the lowest BDI. So this is, of course, a deadly concoction where, as you will see, lot of stress in the industry for most shipping companies. Dividend policy, of course, we have 25%. Obviously, for the year 2015, there is no question of any dividends. In spite of that, if you look at our financial profile, considering where we are as a market, as of now, the BDI has further dropped from what it was as the lowest point last year in December. So from its lowest point, it has further dropped, and it is now at sub 400 level. So it is in the 300, it reached a level of about 350. It is, last night it was about 390 plus, slightly, I think it was 394. 294. Oh, sorry, 294. So we are at sub 300 levels, which is, and bear in mind that the Baltic Dry Index started as an index as a base figure of 1,000 points. So the Baltic Dry Index started with a base of 1,000 points 20 odd years back. 20, about, in fact, just like about 30 years back, and we are at 294 points, which is 30% or less than 30% of its base, which it was 30 years back. So it is something which is very, very unprecedented, never happened, perhaps in the 200 years of shipping. Given all of that, as I said, we have a reasonable balance sheet. We have low gearing compared to our balance sheet numbers, compared to our equity. We have a very low gearing of 0.9. We have a reasonable book value, given the fact that even after we have done an impairment review, even after taking on the impairment charge, our book value or the equity, net equity remains in the region of about $460 million. Even after booking the impairment charges, shows that the size of the condition of the balance sheet is pretty strong, and this is what enabled us to get a good rating for our debenture issue, whereby we could, number one, get the amount which was required, which was about $100 million, and also got a very, very good pricing along with a reasonably long tenor of the debentures. So we could get 5-year money at pricing under 6% in US dollar terms with a bullet repayment of 5 years, and we could get $100 million. So all in all that was possible because we had a good track record, number one, of course, and the fact that our balance sheet size has been very strong. Our equity shareholders have been supportive. They have supported the company when it was needed last year, in the middle of last year. We could raise equity, so therefore the credit rating also took that into account, the ability of shareholders to be able to support the company and the track record of the company, which allowed us to raise further funds on very good terms. We continue to receive awards. Recent awards was the Sustainability award which was received. Then we also received the Corporate Governance Poll award. We got the IR award. So all that, of course, continues and will continue because, as you know, corporate governance remains a top priority for the management of the company. We also got the result of the IOD and the National CG Committee survey and the assessment done for all the companies on the stock exchange, and we have now, for the 6th consecutive time, we have achieved a 5-star rating or an excellence, which is classified as excellent, and we are within that particular group. We are still within that group also in the top quartile. So all in all, we continue to be recognized by various industry regulators, the industry associations for good performance on a number of scores on account of operations or on account of corporate governance, including IR. The Marine Money ranking, of course, we have slipped substantially there. So we are in the 50s now. We have to bear in mind that this is a ranking of all shipping companies in all sectors. So as you would see, the top companies are not companies which are in the dry bulk sector. So if at all, if a ranking was made of companies in the dry bulk sector, we would again be in the top 10. But there are 1 or 2 other sectors which have performed better, or for that matter, every other sector, although not as good, but has performed better than the dry bulk, which has been the worst. Because of this reason, the ranking which is done of all shipping companies, of course, for the company goes down. However, the appreciation still remains, as you can see from some of the quotations made. In spite of the lower ranking, the quotes or the comments made by this particular publication goes to show how the company is ranked or is rated. Shareholders' returns look slightly lower. In spite of that, we still have positive returns. Somebody who had invested in the IPO would still come out top. His investment value would still be in the region of 9 times, so which is still a very, very good record. At various times, if we had invested, we would still be okay, barring if in 2005, where, of course, the share price had reached a peak between 2005 and 2008, At that point, of course, we would have been slightly at the lower level. But having said that, this is a cyclical industry. Hopefully, you will see the same returns as you saw for an investor who would have invested $1,000 or 1,000 baht in 2000. Is still value at the end of 2015 is still 41,000. Hopefully, this is the kind of return you would see for investors who would have confidence in the company, in the company's management, and invest now. At a particular point, you would perhaps see their investment going up not by 41 times, but even 50 or 100 times, as it has happened in the past. With that, we leave the floor open for questions.
Before any ship cancellation, how many new builds do you still have left on the order book? And what will be the total capex size? And how much are you expecting to cancel by?
And repeat the question also because I'm at the floor.
So, before I answer, I'll just repeat the question for the benefit of the audience. You asked for what is the capex of the sort of uncancelled or all the ships which are on order. What do we expect would come in, and what would be the balance, therefore, which would be sort of not come in or would be cancelled. Is that right?
Both the number of ships and in
Terms of the value. Yeah. So as you can see slides 34 and 35, the total capex size is $580 million, out of which number 1 has been received. So that means 22 has gone, 582 means 560. So this is what it is. However, as I said, we do not expect any of the vessels on slide 35, which is the Saint ships, the 12 orders, to be delivered. And therefore, 333 million of value will go out. So, apart from the one which is delivered, 0 from this particular shipyard, and then we are left with 8 undelivered from Sanfu shipyard as per the slide 34. Out of this 8, we expect 4 to be delivered this year. And perhaps the 4 will be cancelled or delayed beyond the next 1, 2, 3 years perhaps. So therefore, in the immediate future, we will have 4, and we hope to get similar settlement done like we did for our first 2 ships with Saint shipyard. If you recall, with Sanfu shipyard, if you recall, the cost of these ships is about $27.5, $27.9 million, depending on which ships they are. As against that, the first 2 ships which were delivered, the price was reduced from 27.9 to 25.5. Thereafter, we agreed that on delivery, we would only pay 21.5 because we have certain issues with the shipyard. There is excess fuel consumption, and therefore we could not agree on what would be the damages payable or what would be the amount of discount. So we decided that we will only pay, and the shipyard agreed to deliver the ships clean, but $4 million less than the discounted price. So 25.5 is the discounted price, out of which delivery is 21.5, and $4 million would remain with us as credit from the shipyard and would be paid after the arbitration award is received, 1 year after the arbitration award, if it goes in their favor. If it goes in our favor, we don't have to pay $4 million. If the damages awarded by arbitration is, say, $2 million, then we have to keep $2 million and pay back $2 million. We are discussing on similar or better terms for the 4 ships which will be delivered. So we will see these 4 ships being delivered at similar discount or similar reduced delivery price or better for us. So this is what it is. So therefore, on these 4 ships, I would expect in terms of cash, there is $80 million of balance capex left in terms of cash. $80 million approximately
for this year?
for this year.
And the remaining four, when would they deliver it?
We may cancel all of them, some of them, and if at all we don't cancel some of them, these we would want to defer it to something, at least not in these 2 years, 16 and 17, where the situation is expected to be tight. So if at all we agree to a delivery of this other 1 or 2 ships, then it would be at a much discounted price, something closer to what the market levels are. Number one, the price would be reflecting that. Number two, the delivery would not be in 16 and 17, whereby we would not have a cash commitment to pay up.
Respected Mr. Khusrowani, the Director of Finance, I appreciate that you are increasing operating days as per the financial highlights of the income statement. I appreciate your 5 stars of good corporate governance and sustainability in investment award. I have a question. You propose to issue a debenture very soon. What would be your credit rating? One question. Second question is regarding your slide on operating expenses. All expenses are reducing except the crew cost that is increasing from the industry norms. How do you plan to control crew cost? Another question is, you have seen negative interest rate in Japan and Sweden recently from the central bank of those countries. In your impact, you have considered only another countries but excluding these countries. Please elaborate what is your opinion in slide risk for 2016 upside risk in this considering Sweden and Europe and Japan. Thank you.
4 questions?
Impact of
Lost track. First question was, maybe we go one by one. So first question is,
rating for your
credit rating was BBB for the company
which is the credit
by Fitch locally, because we did by TRIS because this is local Thai baht debenture which was issued, and it was not proposed, by the way. The debenture has been issued and has been subscribed, and the funds have been received by the company.
regarding the
Operating expenses, as I said, are
industry, you are having higher
operating expenses are, as I said, $1,000 to $1,400 less than any other shipping company probably in the whole world, if you consider. Now, within that, our crew costs are higher. Perhaps the crew is now doing something very, very good, whereby even after this higher cost, we are achieving $1,000 to $1,400 less. So we are perhaps paying $100 more to the crew, but in the bargain, our operating cost by paying $100 more is $1,400 less than others. So perhaps it is worthwhile. This is, you could say, an overall or sort of a perspective, but one of the reasons is that in anticipation of the new ships which will be delivered this year or have been delivered last year, this year, we are undergoing, and we are putting 1 or 2 persons extra on our ships to undergo training, so that when the new ships come in, there is a ready availability of crew which can take over the new ships. Otherwise, we would not have crew to take over the new ships, which would create a big problem. They will not be able to manage. So this is actually a sort of a quantitative reason, but a qualitative reason is that we pay our crew well. We pay nearly in accordance with market levels, but the result which they achieve is far exceeding the additional amount, if at all, we pay to the crew.
I think
high appreciation for operating days increasing.
I think we're run out of time. I think the stock exchange people, because there's another meeting in the same room, so we have to wind this up. If you all have any questions, we'll be waiting outside. We are more than happy to meet you on a one-on-one basis and answer your questions. Thank you so much.